There's continued noise that makes investors nervous and excited, including tariff policy, inflation rates as the biggest concerns. Stocks bounced back as tariff talks pulled back. Bond markets were solid, but the US was downgraded. The chance of recession is dropping, but remains elevated. That and more today as we cover quarterly context. Watch to stay relaxed by staying informed and remain current about things that actually matter to staying focused on your long-term goals and strategy. Welcome to the Quarterly Context webinar for the second quarter of 2025 for clients and friends of the advisory group. I am Greg Patterson, CEO. For those not familiar with the advisory group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realms, their fiduciary and employee support efforts through retirement plans, and their communities through foundations and endowments. To complement this work we do with clients, Quarterly Context webinars are designed to make economic and other information more approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help our clients and their important constituents stay more relaxed and help with those goals. Again, we'll try to keep this to about 20 minutes or a little bit over, and we'll circulate a video link later should you like to view some part of it again or pass it on to someone you think we can help like we help you. We'll cover a number of topics today as mentioned, including tariff talk and recession risk scenarios, as well as some cyclical dynamics that pose interesting questions about what asset classes should definitely remain in a portfolio to benefit from diversification. And as always, we like to remind people to focus on that space between what matters and what you can control, because you can't control markets, but you can control how you respond to them. You can control how you do your planning and your strategy to ensure that you capture the benefit of markets and make smart decisions, both in terms of preparing and spending and design for different needs. The advisory group always places clients first. That's a key part of our business model and has been for decades. This is a valuable element of how clients benefit from independent, thoughtful, conflict avoiding advice. And while conflicts may exist, our design is designed to, in any environment, our design is designed to minimize and avoid them so that clients do not experience those conflicts inherent in the industry. We have large resources and a talented team, and internally and externally have quite a depth of resources that our clients benefit from. As always, there are lots of news elements that may cause markets to move around, sometimes more than you might expect or less. As you might guess, some of the biggest dynamics that were both in the news and that affected markets were tariffs, whether the tariffs are on, whether they're off, whether they're modified, whether they're reduced, increased, delayed. And the overall story was that, as you can see here, the beginning of the quarter was a bit of a hiccup due to a lot of the heavy tariff talk. And then as tariffs were delayed and postponed a bit, markets responded more positively, ending up strongly positively for the quarter. You can see here as the year progressed, the overall big Liberation Day tariff announcement led to a pretty steep sell-off, concerns about the implications for trade wars and inflationary pressures and other dynamics. And then some backing off of that led to a bounce back of markets, and then an increase in tariff talks upward led to a decrease. And then again, the market picked up again after more tariffs were pushed out, whether it was in Europe or the belief or actual progress in China, Europe, and other places. All in all, the quarter ended up setting a new high, which is interesting given the tariff uncertainty. and other dynamics and other political concerns and other geopolitical dynamics. However, it appears that the market is starting to believe that the tariff discussions are really more about negotiations than actual teeth. If we take a look at some of the major metrics, rates held steady. The Fed is still concerned about what the impact of inflation might be and are holding firm despite pressure from Washington in the White House. Inflation cooled down a little bit in the middle of the quarter, but more recently has picked up to 2.7, so still hovering in a reasonable range, but not really cooling down to where the Fed would like to see it, closer to 2%, where they might feel more comfortable lowering rates a bit. Returns, as mentioned, were strong, about 11% across most markets, 11-12% in the US. That was driven by partly and heavily by a bounce back in tech. Some of the big tech stocks, although not all of the big tech stocks, some of the Magnificent Seven did quite well, others didn't do quite so well. So mixed bag, but all in all, some bounce back trading dynamics there, and bonds were up a little more than 1%. Overall employment or unemployment remained about the same level, so hovering around that 4 to 4.2%, and the GDP numbers confirmed that the first quarter had actually, there was some shrinking in the economy, and so far indications are that momentum is slowing further in this current quarter, but no real numbers yet to speak of. We look at markets, we can see here the US up about 11, international continuing the trend of bouncing back and beating the US after an extended period of underperforming the US. Emerging market stocks as well. Overall global real estate about 3%, and the US and global bond markets hovering in solid territory, with the global bonds and international stocks benefiting partly from the increased weakness in the dollar. Interesting to note over here, there are investors who have been nervous about bonds after the rising rate period that caused bond prices to fall a few years ago, as inflation led the Fed to raise rates to rein in inflation, and raising rates pushes bond prices down for existing bonds. But that number is quite solid for a year, a 6% return for bonds, and this 5-year number, which remains negative, is diminishing as that temporary hiccup in bond prices gets absorbed into these higher and raised gradually by the higher yields of newer bonds in this higher rate environment. Really covered some of this tariff dynamics already, but this is something that will continue to have an impact on markets. And again, it seems more like a negotiation tactic than actual firm trade policy, but we'll see. Tariffs have risen across the board, and some of that will stick, some of it may not. And one of our concerns is that that type of volatile approach to trade negotiations and trade relationships can damage relationships and cause nervousness and uncertainty, even if there turn out not to be major tariff increases that can cause other countries and other companies to reroute their trading patterns to diversify out of trade, the same level of trade with the US, and that can harm trade for the longer term. There are also concerns in terms of the Washington dynamics around the Fed. President blasted Federal Reserve Chair Powell, suggesting that he should be fired. The Dow dropped quite a bit right after that, and then the president backed off. Then more recently, there were discussions of the president naming a new chair, but not replacing Powell in order to have some external influence that might offset Powell's influence in terms of the market effect, if not the actual Fed policy. And then just today, news came out that the president told lawmakers on the Republican side that he was planning to fire Powell soon, and then very shortly after that told the press that that was not correct, but that was they denied that statement. So you can read the tea leaves. Will this be actual action, or is it trying to create pressure to cause the Fed and Chairman Powell to flex more and bring rates down sooner? Well, only time can tell. You can see here, just to get a view of what has happened in the last quarter, since the tariff dynamics are such a big part of the discussion in the marketplace and economically. So whereas the average 20-year tariff rate has been hovering around 2.3%, some of the jumps were up to 23, and then average up to 28, down to 18, up to 22, bouncing back and forth, really making a level of uncertainty that's causing companies and countries to pause and maybe in some cases panic, or at a minimum slow down trade and business decisions, which can very directly and already has had a lot of impact on companies and slowed the economy a little bit, as partly as reflected in that negative growth rate mentioned earlier. Despite all of that, given that the market is beginning to believe that the tariff talk is more about negotiation than tactics, than actual policy, markets, after some cooling, have bounced back up right about to where they were, hitting a new high, which also means that valuations are a little more stretched, which means that when they're in this higher valuation range, there's a higher chance of some kind of cooling in the coming years, if not sooner. Just a matter of what would trigger that type of cooling to pull back. So we encourage investors to enjoy this while it happens, but not to get overconfident, and to remain in portfolios that make sense for their long-term goals, consistent with strategy and planning, and rather than emotion or excitement. You can see here again, the US average valuations are towards the upper end of the historical spectrum, whereas most other countries are at or below the average. So relatively more attractive prices, which is a strong and compelling case for maintaining diversification that has already played out with international stocks as they've had some bounce back. And as we'll talk about later, there are other categories as well. Overall, value began to make a creeping back towards recovering some price strength compared to growth stocks, but this last rally that really favored growth stocks and higher risk on type stocks caused the relative value pricing to be lower versus growth. But we don't expect that pattern to last forever. And again, a strong opportunity to maintain diversification, which improve overall portfolio values in the long run. Interesting to see year to date, the value blend and or core and growth numbers are about the same in terms of return if we look globally, and value remains relatively lower since this peak and across most of these other periods, which means that or hints that there is some price rebound opportunity. Some of these stretched asset classes may cool, some of the relatively weaker ones may have a bounce back, and again, great diversification maintenance opportunity. Inflation, as discussed, has been hovering at around that 2.5% level, roughly. The price of oil has been bouncing around with concerns in the Middle East. It spiked a little bit and then cooled back down as things seem to come back under control. But oil is a big component of the overall inflation calculation. Fed numbers have, while brought down a little bit a couple of quarters ago, have flattened out again, still remaining higher than longer. And Fed policy or expectations are that rates will come down. Some projections that are belief based on the Fed quote unquote dot chart that there are 2 possible cuts later in 2025. The market expects maybe 1 or none. So difference in opinions based on what might be happening with politics and tariffs, and hard to know what is being broadcast to offset the complaints from Washington, although the Fed seems pretty disciplined about not being influenced. But are they doing something to broadcast one way to minimize concerns while maintaining internal policy? Hard to say. Normally, these types of games aren't really a question in play in the US, but maybe they are a little bit more now, given these competing demands. Overall, you can see the yield curve normalized a little bit when we go out from the 3-year level out. So it's more like the yield curve that goes up and then up and to the right, but still higher than sort of medium to the early end of longer term bonds compared to the short end here. So it's inverted, but then more normal. And overall, that's some progress, which might suggest a decreased sense of a chance of recession and a positive economic outlook, but still with some concerns given the higher short-term rates. In terms of those recession scenarios, some organizations are expecting about a 40% chance of recession. This is down from 60% recently, which was up from 50% the 2 quarters ago. So a number of different scenarios that could play out. Of course, it's too soon to tell, but still relatively elevated. 40% is not a small or low recession probability, but has gone down a little bit since, for example, some of the tariff talk has cooled and seems to be more negotiations than actual policy. Unemployment, as discussed earlier, remains around that little bit above 4% level. Wage growth has actually decreased a little bit, and that could put some pressure on individuals and reduce spending, which could contribute to a recessionary dynamic if other factors also are at play. Consumer confidence hit a low last quarter, but then bounced up a little bit. However, still at a relatively low level. Now we're back at a level we haven't seen in maybe 15 years, rather than the level we were at not long ago, which at the end of last quarter, which really went back about 50 years in terms of lower confidence. So some improvement as some of the tariff dynamics and other factors and stock markets have picked up a little bit, but still a lot of nervousness out there from the average consumer, especially given sort of the follow-on effects of inflation that are now essentially under control, but that doesn't mean prices have come down. That just means they've stopped going up as fast. Take a moment here for retirement plan clients, those that are self-directed, 401k and others, for example, those that are using custom target date funds or target allocation funds, or that might be using Vanguard target date funds as an example, and then an industry number. It's important yearly to at least have a brief conversation about the shape of this glide path, the pattern at which these funds automatically shift the stock bond mix down for plan participants, so that you are aware as fiduciaries of what that shape of that curve is. It's an expectation of the Department of Labor that you be aware and document this, and just by watching this, you are helping confirm that this process has been reviewed, and we are happy to talk about this in individual client meetings if you're a client using this type of structure. The target allocation funds, which are static, where each participant chooses their fund, we show here the generally recommended allocations by life stage, and of course that's ultimately up to the plan participants to make that choice, but just as a reminder that this is what we talk about with plan participants in education meetings, and to encourage them to use something that's similar to a glide path where that makes sense for their situation. In terms of we got two asset class corner slides for this quarter. One is about international. Talked earlier about how international has been doing quite well, but even if it's been doing quite well, it still remains much more attractively valued than US stocks, as mentioned before. So despite the strength, it's still more of a compelling story in some ways than the valuations of US stocks. This does not mean we suggest eliminating US stocks from the portfolio, but rather just maintaining diversified levels. Those that have been holding international while it lagged for a while are now being significantly rewarded. And that is, again, that's the story of diversification. Similarly, small cap, and in particular small cap value, did not have a bounce back as much last quarter as things began to turn for non-US, non-mega cap stocks. But the relative attractiveness is very high in terms of valuations and other dynamics. So again, diversification will play out. It's just a matter of when, and the reward should be there over time for disciplined and patient investors. It's a quick reminder for foundation endowment clients. Some of this market volatility up and down, a change in rates and so forth is a good reminder for both individuals, but in particular with this structure outlined here for endowments, that different timeframes may require and suggest different portfolio designs. And many of our endowment clients will have multiple portfolios there where they can move money across the portfolios as the timeframes change, so that there's never excessive short-term volatility risk for money that may be spent on projects in the near term. In terms of the rules and regs corner, not a whole lot to talk about. A lot of our people are still digesting the implications of the one big beautiful bill, which is now law. There are some things that if you're in our personal wealth client group, that your advisor can talk to you about and give you some sense about things to think about there that might be helpful. On the fiduciary side, as usual, there's very rarely significant regulatory or structural changes to the fiduciary environment there. However, we do recommend, again, most clients reviewed and updated spending policy last quarter. If you have not done that or completed that, that would be advisable. And as a general reminder, as outlined in a number of our blog posts around endowments, using the term endowment means something very specific in the endowment world under UPMIFA, which is the regulatory body for endowments. And if you call it an endowment, you are subject to specific rules that you might not otherwise be so restricted by if, in fact, it was money that was provided not necessarily under an endowment type gift, but under a less restricted gift. So depending on the nature of the gift, how it's given, how you asked for it, how it was documented, you either have more restrictions or less restrictions. And some donors may not want the restrictions, but if you use the word endowment, you are essentially self-imposing those restrictions when you might not need to. In terms of other policy changes, as the new administration in Washington has pushing different ideas through the system, the pendulum has been swinging back and forth over the last number of administrations in terms of ESG or environment, social and governance, and with less flexibility regarding the use of ESG investments in retirement plans. And there was recently a court case that punished American Airlines for incorporating a component of that in the retirement plan. The crypto dynamics, similarly with the president's particular fondness for crypto, has been trying to make it more possible to hold cryptocurrency in 401k plans. Personally, we think that crypto is not really an asset class, doesn't have underlying fundamental value in many ways like any other currency, and can be more of a momentum play. It may not be appropriate for retirement plans, but this information here is just to be aware that that's happening. There's also been a shift in terms of what might be allowed in terms of availability or flexibility of use of alternative investments, some private, less liquid, and there are dynamics there that make it difficult to implement in retirement plans, but just so you're aware. So, and then ongoing, there are Secure Act 2.0 provisions that may become, that are sort of rolling out and becoming possible or required depending on the case. It's a long and involved list of provisions in that act, something just to be kept abreast of, and your record keeper will automatically be implementing some of those things that are required, and then there should be discussions around some of the optional things to see what's a fit for you and your plan and your company. So with that, we also want to mention that our number of blog posts in terms of, I also have a separate market volatility video that encourage people to hang on, because market bounce backs can happen quite quickly, and that's exactly what happened. So if you haven't seen this yet, it's still a good reminder, because volatility will happen again at some point, and then you'll also want to stay the course if you have the right structure and plan and asset allocation for your particular needs. We wrote a piece that could be helpful if you know of other organizations that might benefit from a new 401k advisor if they're not getting the type of fiduciary and thorough and thoughtful support that we're providing you. If you're a 401k plan client, if you go through this list, you'll find there's a list of 13 points that you'll find that if you are a client, they should all sound like yes, you're covering all those points, but most organizations are nowhere close. So you could be helping a lot of people by passing that on. There's other discussions about volatility, wealth management for women, tax planning strategies for 2025, and so forth. We encourage you to take a look, regardless of what type of client you are. You might benefit from a number of these things. So I want to thank you for attending, and we'll go to questions in a moment. If you have a question, please submit it into the question box. And we also have additional slides that we can run through in client-specific meetings, or if you'd like to contact us to walk through that one-on-one, we're happy to do that as well. So I will pause there and look and see if there are any questions. And if you don't have questions, and sign off. Thank you for joining, and we look forward to talking to you soon.